As we turn the page on the calendar to July, let's begin to take a look at what we believe second quarter earnings will look like. And we'll see those reports start to come out over the next few weeks. So all the data you'll see here is from Zacks. They're a great aggregator of market data, particularly earnings. So the first slide that you see is really a downgrading of expected earnings growth for this quarter throughout the entire year. So the first four bars there are the estimates that were made during the first quarter. And the rest are really what we've seen, during this quarter itself, as we've seen the calendar fly by. And you've seen essentially expectations get cut in half. So there's a number of reasons for this. The biggest one we've talked about on a number of our pieces is uncertainty surrounding tariff policy. That first really came out beginning of April, so you see that impact here. Economic uncertainty, general just kind of economic policy uncertainty, all resulted in really a downgrading of expectations down to about the 4.9 you see on the bottom of the slide. So as we flip forward, let's break it down a little further. So this is the same 4.9. You see that on the top of the chart for the S&P, and then you see a number of segments there below. First thing I would say is just throw out the 105% growth you see towards the bottom. There are always some weird dynamics that may impact things like that, so I wouldn't draw a big conclusion from that. Really looked at things that are pointed left, which means negative earnings growth, and things that are pointed right. So this is, again, second quarter estimates for year-over-year growth. And what you see first on the left are a number of segments that, frankly, you would expect to be impacted by tariffs and goods and trade, if you will. And the things going right are more service-oriented. Not a perfect division, but I think it's a reasonable way to look at this. So you see the numbers there sector by sector. The last slide here I think is probably the most interesting, which this is the estimated change for second quarter versus what actually happened in the first quarter. And again, throw out the huge 100% bar at the bottom, but accepting that, most things are pointed left. So we're expecting lower earnings growth this quarter virtually across the board. And this is very consistent even within those kind of downgrading of expectations. We saw a very consistent picture of estimates being downgraded in a number of areas and resulting in negative growth here in this area. So it probably means a couple of things. One, this is a lower hurdle to jump over. So there's a case to be made that if we do exceed any of these expectations, that there can be some positive momentum that comes with it. So I think that's a reasonable thesis. The other one I think is the caution is we would expect to see the same trend that we've seen over the past few quarters, where if you miss, the company's going to get crushed. And so we saw that last quarter in particular, but even in last year, there was a lot more pain exacted for missing an estimate or expectations than there was for beating them. And so I think you will definitely see that, particularly with this lower hurdle. I think investors are going to say, hey, look, we had very low expectations and you failed to meet them. The stock's going to sell off big time. So look for that as we head into this quarter. Maybe we get the positive side of that with a little bit more positive momentum if earnings are beat, but watch carefully for those that miss.